Psychology, a Money book overview and summary. A brilliant book on how behavior affects financial decisions. It reframes wealth building through a mindset lens, useful for anyone involved in markets. Chapter 1. No One's Crazy. In this opening chapter, Morgan Housel sets the tone by challenging the idea that financial decisions can be universally judged as right or wrong. He argues that people's decisions with money are grounded in the unique experiences of their upbringing, environment, and life context, and therefore, what looks irrational to one person might be perfectly reasonable to another. For example, someone who grew up in the aftermath of the Great Depression may be extremely conservative with money, hoarding cash and avoiding the stock market, whereas someone who came of age during a tech boom may have a high-risk appetite. Housel compares this to how a person's view of politics, relationships, or parenting is shaped by their lived experiences. He points out that since only 0.0000001% of the world's population experiences the exact same market conditions, each person's mental model of money is inevitably different. This chapter urges readers to stop judging others' financial behavior and, more importantly, to understand that their own financial behaviors are not universal truths. This insight is crucial in the age of online finance gurus and echo chambers, where advice often ignores personal context. Housel encourages empathy, self-awareness, and the acknowledgement that we're all improvising the world of money based on the scripts life has handed us. A powerful meditation on the corrosive nature of greed. Housel starts by referencing a story from Kurt Vonnegut and Joseph Heller, where Heller jokes that a billionaire host they're visiting doesn't have anything I don't already have, the knowledge that I've got enough. The idea of enough is the central theme here. Housel examines high-profile figures like Rajat Gupta, a respected CEO who went to prison for insider trading even though he was already incredibly wealthy. Why did he risk it all? Because he wanted more. Likewise, Bernie Madoff had built a massively successful and respected investment firm, but his desire to control more money and maintain appearances led to the largest Ponzi scheme in history. Housel reflects on how the concept of enough is rarely taught or praised in modern society. Instead, we glorify hustle, ambition, and accumulation without boundaries. The danger is that the bar for what constitutes success keeps moving. In the pursuit of more, people often sabotage their long-term well-being, relationships, and freedom. Housel argues that defining what enough means for you and sticking to it is one of the most powerful, underrated financial moves. It doesn't mean rejecting ambition or money. It means recognizing the diminishing returns of material wealth and protecting yourself from the burnout, envy, and regret that come from unchecked greed. Chapter 4. Confounding Compounding. In this chapter, Housel dives into what he calls one of the most overlooked and underappreciated forces in finance, the power of compounding. He highlights how people struggle to grasp the impact of compounding because it defies human intuition. We are trained to think linearly, that if you put in more effort or input, you get proportionally more output. But compounding is exponential. It grows slowly at first and then surges, often in ways that look magical. To emphasize his point, Housel uses the example of Warren Buffett. While people often attribute Buffett's wealth to his intelligence and stock-picking skill, which certainly play a role, Housel argues that Buffett's real superpower is time. He started investing when he was 10 and is still compounding his wealth in his 90s. A large portion of Buffett's $80+ billion fortune came after he turned 60. If he had stopped investing at 30, he'd still be rich, but not legendary. Housel critiques how our obsession with big wins, fast gains, and overnight success causes many investors to underestimate or entirely miss the benefits of staying in the game for a long time. He notes how people chase quick gains, jump from one strategy to another, or try to beat the market over short horizons. The result? They interrupt the very process, compounding, that creates sustainable, outsized wealth over decades. His takeaway: the key to success is not necessarily earning the highest return, but earning a good return for the longest period of time. Compounding rewards patience, consistency, and time more than brilliance. Chapter 5. Getting Wealthy versus Staying Wealthy. Housel makes a sharp distinction in this chapter between two very different financial skills: getting rich and staying rich. Getting wealthy often involves risk-taking, optimism, and bold decisions. Staying wealthy, however, demands a very different mindset, one rooted in humility, fear, and careful preservation. To make this point vivid, Housel reminds us that countless people have made large fortunes only to lose them, through overconfidence, leverage, or by misjudging risk. He explains that staying rich depends on three core traits: a frugal mindset, paranoia about risk, and the ability to stop moving the goalpost. This echoes the idea from Chapter 3 about knowing what is enough. He likens the challenge of staying wealthy to surviving in a game of Russian roulette. You might get away with risky behavior for a while, but eventually the odds catch up. Therefore, building financial resilience is not about maximizing returns every year, but about building in a margin of safety, a financial cushion that protects you from the unexpected. Housel also emphasizes the importance of avoiding financial ruin at all costs. This isn't just about avoiding debt or scams. It's about structuring your financial life in a way where no single bad event can wipe you out. It's not sexy advice, but it's the most essential. Survival is the foundation of wealth. Without it, nothing else matters. In essence, the person who can stay in the game without getting blown up is the one who eventually wins big. Chapter 6, Tails You Win. This chapter introduces one of Housel's most powerful ideas: tail events, or the extremely rare but massively impactful moments in life and finance. He explains that most of the outcomes in business, investing, and life are not distributed evenly. Instead, they follow a power law. A small number of events produce the vast majority of results. He uses several fascinating examples to make his point. In venture capital, a handful of investments return the majority of the fund's profits. In the stock market, a few giant winners like Apple, Amazon, and Google generate most of the market's gains, while many others remain flat or lose money. Even in everyday life, a few decisions, relationships, or opportunities disproportionately shape the trajectory of someone's life. Housel argues that success often comes from being positioned to benefit from tail events, and not necessarily from constantly being right. You don't have to succeed all the time. You just need to be right once in a big way. And to increase your odds of catching one of these rare events, you have to stay in the game long enough and keep placing yourself in situations where big wins are possible. For investors, this might mean holding on to great companies for years instead of selling early. For entrepreneurs, it means being okay with a string of failures, as long as one success pays for them all. His advice is simple but transformative. Embrace the idea that a small portion of your actions or investments will produce the majority of your results. Focus your energy on surviving, staying patient, and remaining exposed to asymmetric upside. Chapter 7, Freedom. In this deeply personal chapter, Housel argues that freedom, especially the ability to control your own time, is the ultimate form of wealth. He notes that many people mistakenly chase money as an end goal, thinking that more possessions, luxuries, or accolades will bring happiness. But in his view, the most valuable dividend that money can pay is autonomy, being able to do what you want, when you want, with whom you want. He shares the story of a wealthy executive who worked grueling hours and flew in private jets, but envied a neighbor who could pick his kids up from school every day. That neighbor wasn't as wealthy, but he had something the executive lacked: control over his schedule. Housel connects this to studies that show one of the strongest predictors of happiness is having flexibility and ownership over your time. It's not the mansion or the fancy car that leads to contentment. It's being able to live life on your own terms. This chapter challenges the traditional view of financial success. Housel suggests that many people trap themselves in high-income lifestyles that rob them of freedom. They earn more, but also increase their obligations: longer hours, higher stress, and less control. The irony is that financial success should give you more control, not less. The big takeaway here is simple. When making financial decisions, ask yourself whether those decisions are buying you freedom or selling it away. Building wealth should be about reclaiming time and choice, not impressing others or feeding an ego. Housel calls this the highest dividend money pays. Chapter 8, Man in the Car Paradox. Here, Housel reveals a surprising truth about status and envy. He introduces the man in the car paradox, the idea that when we see someone driving a fancy car, we rarely admire the driver. Instead, we imagine ourselves in the car. We don't think, wow, that person must be smart or successful. We think, if I had that car, people would admire me. This paradox reveals a painful truth about human psychology. We often chase expensive things not for ourselves, but for the imagined approval of others. Yet, ironically, those others don't care about us. They're projecting their own fantasies, just as we are. Housel argues that spending money to gain respect or admiration rarely works, because people don't think about you as much as you think they do. They're too busy thinking about themselves. This chapter is both humbling and liberating. It exposes a trap of material signaling and offers an alternative mindset. Rather than seeking admiration, seek authenticity. Use money to support a life that aligns with your values, not one that tries to impress strangers. Housel's advice is clear. The best way to gain respect is to be kind, humble, and honest, not to flaunt wealth. True admiration is earned through character, not consumption. Chapter 9. Wealth is what you don't see. This chapter flips our understanding of wealth on its head. Housel distinguishes between richness, the visible signs of money, like cars, clothes, and luxury items, and wealth, which is invisible. Wealth is the money that hasn't been spent yet. It's the uncashed options, the unused vacation days, the savings and investments that haven't been converted into consumption. He makes the point that when we see someone with a fancy house or expensive watch, we are witnessing a decision to spend, not a reflection of how much money they have. In fact, many people with high visible spending have very little actual wealth because they burn through their income to maintain appearances. Conversely, those who live modestly may be far wealthier than they seem. Housel argues that the most powerful financial move is to save money without a clear reason. That might seem counterintuitive, but it reflects the understanding that life is unpredictable. Having cash on hand, or the ability to walk away from a job, cover surprise expense, or seize an opportunity, is a form of wealth that provides optionality and control. It's not flashy, but it's incredibly powerful. The core message: just because you don't see someone's wealth doesn't mean it isn't there, and what you do see isn't always real. Don't confuse high spending with high success. Aspire to build real, quiet wealth that supports long-term freedom, not just temporary applause. Chapter 10. Save money. In this chapter, Housel returns to a fundamental principle of financial success: saving. While it may seem obvious, he emphasizes that saving money is one of the most underrated and misunderstood tools in personal finance. Many people think that building wealth is all about high incomes, investment returns, or complex strategies. But in reality, wealth creation begins with simply spending less than you earn, consistently and for a long time. Housel debunks the idea that you need a six-figure salary or sophisticated portfolio to become wealthy. Instead, he champions a mindset of frugality, modest lifestyle inflation, and disciplined saving habits. Saving, he says, is a function of your behavior, not your income. In fact, a high income can be dangerous if it leads to high spending, because it creates a fragile lifestyle that is easily disrupted. He also points out that saving money gives you options. It buys you time, flexibility, and the ability to say no. Whether it's switching jobs, starting a business, taking a sabbatical, or handling a crisis, savings provide a cushion that empowers you to make better decisions. Importantly, he urges readers to save not for a specific goal, but simply for the ability to act independently when life surprises you, which it inevitably will. The chapter's message is simple but powerful. Saving is a gap between your ego and your income. If you can learn to be content with less, you can accumulate more than you ever imagined. Chapter 11. Reasonable, rational. This chapter explores the idea that when it comes to money, being reasonable is better than being perfectly rational. Housel argues that humans aren't logical machines. We are emotional creatures influenced by fear, pride, love, and anxiety. Therefore, financial strategy should be designed not just for mathematical optimization, but for psychological sustainability. He gives the example of paying off a low-interest mortgage early. From a rational perspective, this doesn't make sense. You can invest that money and earn a higher return. But if eliminating debt helps you sleep better at night or feel more secure, then it's the right move for you. Similarly, some people prefer cash over investments, even though cash earns less, simply because it provides peace of mind. Housel believes that personal finance should be personal. A strategy that looks perfect on paper but causes you stress, regret, or constant second-guessing is a strategy you won't stick with. It's better to choose a good enough plan that fits your personality and lifestyle than a flawless one you can't maintain. The chapter challenges a cold, spreadsheet-driven view of finance and offers a more human approach. Success isn't just about making the right choices. It's about making choices you can live with through both good times and bad. Chapter 12. Surprise. In Chapter 12, Housel emphasizes the importance of recognizing that the biggest financial events are often the ones no one saw coming. Whether it's market crashes, pandemics, economic booms, or personal windfalls, many turning points in history and in our own lives are driven by unexpected forces. He reminds us that the world is full of surprises, and the future is inherently unpredictable. He warns against the temptation to rely too heavily on models, forecasts, or patterns from the past. History, while valuable, doesn't repeat. It rhymes, and often in ways we can't anticipate. As such, we must prepare for the unexpected, rather than pretend we can predict it. This means building flexibility into our plans, maintaining a margin of safety, and avoiding the mistake of thinking we've seen it all. Housel also touches on the limits of knowledge and the dangers of overconfidence. Experts often make confident predictions that turn out to be wrong, not because they're foolish, but because the world is too complex to forecast perfectly. He encourages humility, not just in investing, but in life. The core message here is to plan for a future that will probably surprise you. Diversify, stay adaptable, and don't bet everything on any one outcome. In Money and Life, resilience beats precision. Chapter 13, Room for Error. In this chapter, Housel emphasizes the critical importance of building a margin of safety into every financial decision. He compares managing money to engineering, where structures are built to withstand stress beyond their expected load. Similarly, your financial life needs to be structured with room for error, not because you're pessimistic, but because the future is unpredictable. He argues that most financial plans fail not because they're flawed, but because they don't account for the unexpected. Whether the market crash, job loss, medical emergency, or personal setback, you will inevitably face surprises. And if your plan doesn't include a buffer, you're exposed to collapse. Importantly, Housel explains that people often confuse the probability of something going wrong with the consequences of it going wrong. Even if the chance of failure is low, if the downside is catastrophic, it's not worth the risk. He applies this logic to investing, suggesting that smart investors don't aim to be right all the time. They aim to stay in the game long enough for their strategies to pay off. That means planning not just for likely outcomes, but for the possibility of being wrong. In short, resilience beats precision. Don't optimize your finances to the edge of perfection. Optimize for endurance. It's better be pretty good and still standing than to be perfect and wiped out when the storm comes. Chapter 14, You'll Change. This chapter explores a surprisingly overlooked reality. Your goals, values, and desires will change over time, often in ways you can't predict. Housel calls this the illusion of permanence, where we assume our current preferences are fixed and will guide us forever. But when we look back at who we were 10 years ago, we often see a totally different person with different tastes, dreams, and priorities. He argues that this makes long-term financial planning incredibly tricky. You may think you want to retire early, live in the city, or build a business, but what if your future self wants something else entirely? What happens if you sacrifice your present life for a future goal you no longer care about? Housel doesn't say you shouldn't plan. Rather, you should plan with humility. Accept that your future self might not agree with your present self. This mindset encourages flexibility. Instead of rigid goals, he advocates for broad, value-driven planning, saving money and making wise investments not for one narrow goal, but for the ability to adjust when life shifts. He shares stories of people who sacrifice relationships, health, or happiness in pursuit of a goal, only to reach it and feel empty. The key, Housel says, is not to be so sure of who you'll be in 20 years that you trade away everything today. Give yourself room to grow, evolve, and pivot. Chapter 15, Nothing's Free. Here, Housel unpacks a powerful truth. Everything has a price, even if you don't see it up front. The price of building wealth, he says, often isn't financial. It's the emotional cost, dealing with volatility, stress, uncertainty, and doubt. The mistake many people make is thinking that if an investment or path is uncomfortable, it must be wrong. But in reality, volatility is the price of admission to long-term wealth. He draws an analogy between markets and amusement parks. You don't get the ride without the ticket. And the ticket to superior investment returns is the ability to endure downturns and stick with your plan when others panic. The problem is this fee doesn't come with a price tag. It comes in the form of fear, anxiety, or temporary losses. And because it's not billed like a product or subscription, people don't recognize they're paying it. Worse, they try to avoid it by panic selling, switching strategies, or chasing free paths to success. But Housel argues that successful investors accept this emotional fee as a feature, not a bug. They understand that wealth comes from staying in the game, not avoiding discomfort. The ones who fail are often those who try to avoid paying this invisible price and end up quitting when things get tough. His advice: don't look for strategies with no cost. Look for strategies where the cost is worth it. Endure the discomfort in service of the bigger reward. Chapter 17. The Seduction of Pessimism. Housel tackles a psychological bias that pervades financial thinking. We're more attracted to pessimism than optimism. Bad news grabs attention faster and seems more credible than good news. When someone says the market will crash, it sounds like caution and wisdom. But when someone predicts growth and progress, it sounds naive or overly optimistic. Why is this the case? Housel explains that pessimism sounds smart because progress tends to happen gradually, while disasters are sudden and visible. A single market crash, natural disaster, or economic downturn can erase years of steady gains, at least temporarily. Our brains are hardwired to overreact to loss and danger, a trait that was useful for survival in prehistoric times, but leads to flawed financial behavior today. He illustrates how the world has improved tremendously over the last century, in wealth, health, innovation, and opportunity. Yet the dominant tone in financial media is often fear-based. It's easier to sell doom than discipline. Housel urges readers to be deliberately optimistic, not because everything will go perfectly, but because the long arc of history shows that human progress tends to win in the end. This chapter reminds us to fight against our negativity bias. While risk is real, so is resilience, innovation, and recovery. Investing with optimism, tempered by prudence, is not foolish. It's historically sound. Chapter 18. When You'll Believe Anything. In this fascinating chapter, Housel discusses how people tend to construct stories to make sense of randomness, especially when it comes to money. Human brains crave patterns and narratives. We want to believe there's a reason why markets crash, why bubbles happen, or why someone got rich, even when the real answer might be simple luck, coincidence, or noise. Housel calls out the danger of the storytelling impulse. We create false causality, attributing success or failure to traits like intelligence, bravery, or foolishness, when randomness played a much larger role. This is especially true in finance, where outcomes are heavily influenced by timing, macroeconomic shifts, and unforeseeable events. He also warns against the illusion of control, the belief that if we just had the right information, we could perfectly predict or manage financial outcomes. But the truth is, the world is too complex and chaotic for that. Humility is key. The takeaway is not to be cynical, but to be cautious about the narratives you consume or construct, especially in investing. Don't blindly trust the stories that surround big gains or losses. Instead, focus on long-term behaviors that stack the odds in your favor, and accept that luck and randomness play a bigger role than we want to admit. Chapter 19. All Together Now. In this final chapter, Housel ties together the core ideas from the book and emphasizes the importance of simplicity, humility, and self-awareness in managing money. He begins by reiterating that good investing is not necessarily about making brilliant decisions, but rather about consistently avoiding major mistakes and staying in the game for the long haul. You don't need to be a genius. You need to be reasonable, patient, and emotionally in control. He reflects on how everything from earlier chapters, room for error, compounding, tail events, personal goals, the seduction of pessimism, and understanding your own game all lead to one central idea. The ability to manage your own behavior is more powerful than any technical strategy. This chapter also challenges the idea that financial success requires complex knowledge. Most people think they need to master spreadsheets, advanced analytics, or financial jargon to succeed. But in reality, behavioral discipline, saving consistently, avoiding debt, being skeptical of hype, and staying invested during volatility matters far more. Many highly educated people fail at money management because they lack behavioral awareness. Housel urges readers to define their own version of success. Don't let social comparison or flashy stories of wealth lure you into playing a game you can't win. Wealth is what you don't see. It's the money saved, the risks not taken, the life not mortgaged for social approval. Financial success, he concludes, is not about beating the market. It's about living a life where you have control over your time, your stress, and your choices. He closes with a reminder that good financial behavior is universal and timeless. While markets change and tools evolve, the psychological patterns around money remain deeply human. Know yourself, respect luck, prepare for failure, and value freedom. These are the true foundations of wealth. Postscript. A brief history of why the U.S. consumer thinks the way they do. In this insightful postscript, Housel shifts focus to a macro perspective, examining how history and generational experiences shape our beliefs about money. He explains that Americans' financial behavior today is heavily influenced by historical events, especially the Great Depression, World War II, and the economic boom of the mid-20th century. For instance, older generations who lived through scarcity became savers, while younger generations born during economic abundance were more comfortable with risk and debt. This generational divide helps explain everything from saving rates to investment trends to real estate preferences. Housel argues that people's attitudes about money are not just personal, they are cultural and historical. He highlights how the rise of credit, the decline of pensions, the explosion of housing prices, and the advent of consumerism in post-World War II America created a new financial mindset that still influences behavior today. Understanding this context is crucial when analyzing consumer trends, financial decisions, and investor psychology. Ultimately, the postscript reinforces a central theme of the book. There is no single, rational way to manage money, because we're all shaped by different experiences, upbringings, and social environments. What feels safe to one person may feel risky to another, and both are right in their own context.